Welcome to The Explainer. Today we are cracking open the black box of the stock market. Look, if you're getting into consulting or finance, this isn't just some abstract theory. This is the practical stuff, the real architecture of how trading actually works. So, let's get into it. On the surface, it seems so simple, right? A company creates stock, you buy it, maybe you sell it. But behind that very simple question is this massive, incredibly fast ecosystem. It's a whole world of rules and players and strategies that really determine who wins and who loses. Okay, let's dive in. So here's our game plan for today. We're going to start with the 30,000-foot view of the market structure. Then we'll zoom way in to see the mechanics of a single trade. After that, we'll take a look at how the pros, the big money players, approach the game. And then we'll wrap it all up so you're prepped for your next big interview. All right, first things first, we have to understand the landscape. I mean, before you can trade a stock, that stock actually has to exist in the first place. And that happens in a very specific arena. The best way to think about capital markets is to picture a giant highway system for money. Seriously. It's the whole infrastructure that connects companies that need cash to grow with investors who have cash and, want to earn a return on it. And this highway system has two main roads, each serving a totally different purpose. Now, these two markets are completely linked. The primary market, that's where a company has its initial public offering, its IPO. It's like the factory floor, where the stock is built and sold for the very first time. But think about it. Who would buy a brand new car if there were no roads to drive on and no way to ever sell it later? That's what the secondary market, your NYSEs, your NASDAQs, provides. It's the entire network of roads and used car lots. This table really nails the key differences. In an IPO, that price is fixed. It's a one-time thing to raise capital, mostly for big institutions. But in the secondary market, that price is alive, it's constantly moving with supply and demand, and hey, it's open to everybody. So the real takeaway here is that the secondary market provides the liquidity, the ability to easily buy and sell, that gives investors the confidence to fund new companies in the primary market. You can't have one without the other. So now that we know where all this trading happens, let's dig into how it happens, because this is where your strategy as a trader really begins. This right here is the fundamental choice. It's the trade-off every single investor has to make, whether you're buying one share or a million shares. And how you answer this question determines the type of order you place, and trust me, it has major consequences. Okay, so if you absolutely need to get into a stock or get out of it right this second, you use a market order. You're basically telling your broker, get this done now. I don't care about the exact penny, just execute the trade. You're all about speed, which means you're demanding liquidity from the market. The trade-off, the price might slip just a tiny bit between the moment you click buy and the moment it actually executes. But what if you're not in a rush? What if getting the exact price you want is what really matters? Well, then you use a limit order. With this, you're saying, hey, I will only buy this stock at this specific price or lower, not a penny more. You get total control over the price, which is great. The risk, though, is that the trade might never happen. Your order could just sit there if the market never comes down to your price. In this case, you're not demanding liquidity. You're actually providing it to the market. Okay, so we've got our two basic order types. But when we start talking about hedge funds, pension funds, the real big money, well, they are playing a completely different game, and they're using much, much more sophisticated tools. First, you have to meet one of the most essential players on the field, the market maker. The easiest way to think of them is as the specialized shopkeepers of the stock market. Their entire job is to always have stock on their shelves, ready to buy from you or sell to you at any given moment. They make their money on a tiny price difference between what they buy it for and what they sell it for. That's called the bid-ask spread. They're so important because they provide that constant flow, that liquidity that keeps the whole market humming along. Now, here's a classic consulting-style problem. Imagine a huge fund wants to buy $100 million worth of a single stock. They can't just slam a giant market order into the system. The second they do that, everyone sees this massive wave of demand, and the price would just shoot to the moon before their order is even halfway filled. No, they have to be sneaky. They have to use stealth. And this is one of their go-to secret weapons. It's called an iceberg order, and it's pure strategy. What you do is you take a massive, say, 1 million share order, and you break it into two parts. A tiny little visible tip, maybe 100 shares, that everyone can see, and a huge hidden bulk that's completely invisible to the rest of the market. So what happens is, as soon as that little visible tip gets bought up, the system automatically replaces it with another small piece from that massive hidden reserve. The goal here is simple. You execute a huge trade without tipping your hand and sending the price soaring against you. Now, if you're a consultant, this is gold. You'd advise your client that using strategies just like this is absolutely essential for managing their market impact and getting a better average price. We're talking about saving millions of dollars on a single trade. Okay, let's bring it all home. You're sitting in that interview for a consultant gig or a finance role. How do you prove that you actually get how this complicated world works? Let's boil it down to the absolute essentials. Look, if you remember nothing else, remember these three things. 1. The market is a two-part system. Creation happens first, then trading. 2. Every single trade is a strategic choice, a trade-off between speed and price. And 3. Liquidity isn't magic. It doesn't just appear. It is actively manufactured by market makers, and it's strategically managed by the big institutions. And you've got to be ready for questions like these. For number 1, your answer is all about that symbiotic relationship. It's about liquidity. For 2, think about urgency versus control, like what if some huge news just broke about a company? And for number 3, remember the key difference. A broker is your agent, working for you. A market maker is a principal, trading for their own company to provide liquidity to everyone. Nailing those functional differences, that's what makes for a great answer. And that really leaves us with the big, defining question that's shaping the future of finance. As the machines get faster and the strategies get more and more complex, who's really in the driver's seat? It's something the next generation of leaders in this space will have to figure out. Thanks for joining this explainer.